Hi, this is Dan Collins, Editor-in-Chief of Modern Trader Magazine, coming to you live from the floor of CME Group on December 15th. We're coming to you one day after the most boring Fed meeting of several years, as the Fed, as everyone expected, tightened interest rates by 25 basis points. Not a whole lot of immediate market reaction to it, but since then the market has sold off and the dollar has done real well. Hard to say why, but the most likely reaction is there was one change, which was the dot plot that all the four Fed governors produces indicated that there'll be 3 interest rate increases next year instead of just 2. Not quite a full point because it's an average of all their dot plots. But if you recall, last year at the 2015 meeting, there was an expectation of a full 100 basis point increase in 2016. We only got 1. So I think necessarily the Fed's a little bit optimistic on the economy. They don't want to say, boy, we're not going to be able to raise interest rates at all after being stuck at 0 for 8 years. So you need to take that with a little bit of a grain of salt. Now, Janet Yellen did say they looked at some of the things that President-elect Donald Trump and worked that in, though it did not have a very large meaning. What we know from the Fed's perspective is going into this meeting, they were expected to increase by 25 basis points. Expectations for 2017 prior to the election was for 2 additional increases. Same as probably last year, because if you looked, by the way, if you looked at the Fed funds futures, which we talked about and kind of recommend you do, they were pretty much right on the money as far as one increase in or less than a full point increase in 2016. Slight chance more than 2 increases right when they increased in December 2015, but it slowly went to the point where there was actually an expectation of no increase. But if you look at a January Fed funds, January 2007 Fed funds futures contract, going back to last year, you'll see that it stayed in a barrier that indicated just 125% increase. So if you're looking forward thinking, don't necessarily look at the Fed's dot plot, but look at the Fed fund futures. Now we know that President-elect Donald Trump had recommended a huge stimulus package and a large tax cut, both of which would be inflationary, both of which would push the Fed to maybe increase the pace of tightening. So follow what gets passed, also follow Europe and Asia. Negative rates there right now. One of the big questions, one of the big, headwinds facing the Fed is the fact that they're going the opposite direction. So that's going to restrict them somewhat. They're going to play their game and tighten as necessary, but it'll be hard to be moving interest rates higher when Europe and Asia are moving it lower. So stick to the expectation of 2 increases, maybe 3 if some of these things happen, and look at how big of a differential will be allowed. If the EU carries on with some of its tapering, there's a news item today that Japan may actually tighten from its negative rate level. That would give a little bit of room for the Fed to act more if it wants to. This has been Dan Collins for Traders Exclusive. See you next time.